And thank you so much for your mention of your name and surname. I copy this information after recording to save this information for my KSU 24 journal. So I plan to start from description of syllabus when you will learn during this semester, and I share screen for you. Could you please to say when you see the screen?
Yes.
Okay, thank you. So the title of our course is Time Series Forecasting for Business Analytics, and you are first students who wish to know this course in English, and I'm very glad to see it. As I remember, Vladislav Ungurian prefer maybe with translation, but I think that I prepare a course in English plus Ukrainian to deeply understand all course material which I will present for you. And our topic of today's consultation is to consider syllabus, to consider main tasks for your preparation and assignments, and at least introduction lecture, which I will send to you after this class to consider in detail personally. So when you know this is a main information about this course, I reconsider link in KSU Online because I revise some materials. So I will send you additional message. Then this information will be prepared, and before it, I will send all necessary information in your chat in Telegram for preparation of new assignments. So our course includes topics related to data analysis in R language and RStudio framework. You will learn instrumental methods which allow you to make prediction using big data in micro and macro levels for decision makings by economics organization. And the main topic will be time series, which you consider in our today classes. The course aims to address data analysis in RStudio to predict some economic and financial indicators for decision makings. And the main tasks you can see, it's applying of least squares method and maximum likelihood methods for forecasting in RStudio. Hypothesis testing using R, the principal component analysis in multicollinearity regression in RStudio. Forecasting and building confidence intervals for heteroscedastic and autocorrelation regressions in RStudio. The all competences after completing all these courses includes general competence, the ability for abstract analysis and synthesis, because you will consider different situation where we need to divide all entity on separate components and to reveal some relations between these components and to combine each after considering in one model and such call it a synthesis of the model. Ability to communicate with representatives of different groups at different levels. So you need to know some domain, economic, financial, machine learning, to deeply understand the task and assignments which you will have, and ability to evaluate the quality of your work. So using different metrics such as R-squared, RMSE, MAE, etc. Your professional or special competences, it's ability to apply information and communication technologies to solve different tasks, to use modern data analysis technologies to optimize process and information systems, to apply analytical methods based on the requirements of the subject area, and ability to determine and verify forecasting estimators of your models. So, for example, using financial instruments. And at least program learning outcomes, you need to find some necessary information to add it to your assignments, to interpret and to understand the results which you will obtain. To develop and to use data in some databases, perform data analysis to support decision making, and predict, analyze, and interpret the results of financial processing using different tools such as parametric and non-parametric methods. You will have the main 4 labs for preparing, and after that you will get assignments which you can apply previous knowledge in new domain. So it's your first steps in preparation of these courses. So here you can see known for you instruments, for example, R programming language and RStudio. In this case, POSIT company now owns RStudio, but in this case, you can very quickly to find it or using cloud version of RStudio. And maybe not so actual now, some information about forums of RStudio programmers, because now we have some very many bots which you can use to find necessary information. Course policy about independent preparing your tasks according to requirements of academic integrity, and description of our course with 2 modules, forecasting and hypothesis testing in R, and data analysis and visualization in RStudio. So here you can see some labs where you will consider some main tasks which you need to prepare. It will support by necessary textbook which you will have for preparation these tasks, and some examples for you where you can consider as additional resources for preparation. And for example, our course will be divided in current assignments, which will have 50 points, and final assignments in exam also 50 points. And in this case, in some you will have 100 points. In this case, you will have opportunity to use some additional course, for example, using Coursera or Udemy for preparation. And if content of this course coincide with learning outcomes of this course, I can estimate your additional 10 points or 10% from 100 maximal points of these courses to your course, if it will be necessary for you. So list of necessary courses you can see in the end of this syllabus. So this syllabus I will send after this class to you bot, to your chat, and simultaneously I will prepare separate course in English in KSU online. So it's a first part of our class, and now I would like to present for you first labs. These labs now in Ukrainian, so I will translate these lab works for you in the during nearest week. But here you will have possibility to see some examples in the start of this lab. And after that, you will have some assignments for your own preparation. For example, in this case, it's a least squares method in RStudio or OLS in RStudio. Here you can see main tasks. So for example, here you can see 10 main tasks. For example, if you prepare 10 tasks from 10, it will be 90% of your work. And this percent I will multiply on maximal grade for this assignment. It will be your grade for this lab. So in this case, you can see tasks which you can prepare during this course. And the rest of labs have same structure. So you will have some explanation what you need to do with some data set, and after that you will have some points of necessary tasks which you will need to prepare for all of these 4 main lab works. But you will have additional tasks for time series data, because it's some beginning task to remember some formulas, some libraries from RStudio. So you can see here some explanation, and after that you can see some tasks for this course. And at least lab number 4, heteroscedasticity. So here you can see some explanation, and after that some tasks for you. I will translate these assignments and upload this information on KSU Online. So you will have some set of tasks which you need to prepare during, for example, current month. I think till beginning of November. And after that, I will explain what you will need to do to prepare to final exam. And now I would like to continue our today class, taking into account our specific of our course. And I would like to share screen. Just a second, I will open necessary file, and after that in full screen, and after that I can share my screen for you. Could you please to say, can you see a slide of our presentation?
Yes.
Okay, very good. So in context of our course, time series forecasting for business analytics, I would like to consider some main topics such as time series analysis, indexes, and forecasting. In this case, I would like to present the goals. After completing of this part of course, you should be able to do following things: compute and interpret index numbers, weighted and unweighted price indexes. In some cases, it's necessary to do some pre-processing of information before you need to apply some machine learning models or neural networks model to understand some specific of tasks. And in this case, we need to understand how to build these indexes before we can prepare necessary information to process them. Because time series is some prediction, some forecasting of different phenomena, not only economic and finance, but also physical, such as rain, such as weather, and in this case, it can be different level of abstraction where you can use quarterly indexes, day indexes, hour indexes, minute indexes, for example, cryptocurrencies, etc. It's also necessary to test randomness in a time series, identify the trend the main tendency, for example, for time series seasonality or violation of this time series cyclical and irregular component in a time series. We need to decompose some trend to understand how to predict the next value and to make necessary decisions. In this case, we can apply smoothing-based forecasting models, including moving average and exponential smoothing, and apply autoregressive models. Maybe you remember that you did it in our previous courses, in elective courses, such as maybe in third course of your bachelor degree. Apply autoregressive models and autoregressive integrative moving average models. So in this case, it will be a preparation for final control in context of these courses. So to build some time series, we need to understand why index number is important. Because in some cases, absolute value does not demonstrate some tendencies or can demonstrate some unknown phenomenon, so without clear trend. So in this case, to understand some trend, we need to transform our absolute value indexes to understand more about some research value. In this case, index numbers allow relative comparisons over time. So in this case, we have some coefficients or percent when we build indexes. Index number are reported relative to a base period indexes. In this case, there are two main systems to build indexes. It's a base period indexes and current period indexes. We can use any of them. It depends on what we prefer and in this case we can use some average results from this one. In this case, it's a proposal to start from base period index and use it for an individual item or measurement. So when we consider observation all the time, for example, price of single item, it can be price of share or stock in the, for example, stock exchange market, or it can price in internet store, etc. And we would like to reveal or disclosure some a tendency, or in this case, to understand how we can, for example, to invest in this finance market, or for example, to buy or to sell some finance instrument. And to form a price index, one time period is chosen as a base, as we mentioned above. In this case, in this base, it can be initial or previous, previous value or current value. And the price for every period is expressed as a percentage of the base period price. In this case, we need to assign some indexes. In this case, let P0 denote the price in the base period. So it's an initial before current period. And let P1 be the price in a second period. So the price index for this second period is P1 is divided P0, or if we want to have a percentage, we need times 100. In this case, we transform our coefficient to percentage. It depends on our preferences. And this relation of prices, or relation of these prices times 100, it will display the same value. So, for example, in this case, if we consider different years and the price of ticket, for example, for airplane from 1995 to 2003, we in this case we can consider, for example, the price of 2000 years as a base, and in this case any value of price in this time series we need to divide on this same value. For example, price in this year 2000, and after that we will see, for example, that in 1996 the price of tickets was 20% of price of 2000 year, and in this base year it's we understand why it's 100, because nominator and denominator are same. And for example, the last example, it's we can see that in 2003 our price will be on 20% more than price in 2000. So in this case, price of 2003 is 120% of price in 2000s. So in this case, it's in some cases it's very useful to transformate absolute values, for example, of prices in some indexes, and after that to process indexes to reveal more strong trends or more strong patterns than only for absolute values of prices. So in this case, you can see some list with interpretation how to understand these values for each year. And we can distinguish between two types of indexes. So in this case, we can see that in contrast of previous individual indexes, then the price of 1 year we divide over the index of next year. We can construct aggregate price indexes. So in this case, an aggregate index is used to measure the rate of change from a base period to a group of items. So in this case, we can calculate, for example, unweighted aggregate price indexes, or it's a case where weight of each indexes is the same. In this case, we don't need to propose some weights. And the second type of aggregate price indexes, it's a weighted aggregate price indexes, or for example, less Paris indexes, where we use previous value as a base for calculation of each next value for our meanings. And in this case, for example, when we know for stock exchange market, for example, close price and volume of trading in this day. So in this case, we can use not only closed price, but closed price times value of trading in this day. And in this case, the average price will be more typical for this type of consideration, because it includes not only price, but also quantity of values of trades in this day. So we need to apply some example. In this case, for example, unweighted aggregate price indexes for period T, for example, it can be some months or some years or some days for a group of car items. In this case, we have, for example, prices in period T, for example, current period, and some of prices in base period. In this case, it's we can understand the dynamic of prices in some period of time. But in this case, in different time period, we can sort different types of good, or we will consider different quantity, and some formula can be not corresponding to all situation. In some situation, it may be. Or for example, when we compare between themselves, for example, then they create a portfolio with equal weighted for each financial instrument. For example, we have 5 financial instruments, and each of them has 20% in our portfolio. 20 times 5 will be 100%. And in this case, we can compare only prices. Don't take into account prices of each financial instrument. Don't take into account the quantity or values of these assets. But this formula cannot be applied for all possible cases when quantities is different for different financial instruments. For example, we can consider automobile expenses. For example, what we can see. We can see, for example, that in 2001 years, we have some expenses for automobile lease payment, if we have credit on our car, full and repair. In total, for example, we need to pay monthly 345, for example, dollars. And in 2004, we have another value of payment, more 310, 50, and 50, in total 410. And in this case, we have dependence between our expenses in 2004 in contrast of 2001. And in this case, our expenses after 3 years will be on 18.8% more than in previous years. So in this case, we can apply individual indexes where we can divide one number on another, where the example of this number is automobile expenses per month. I think it's totally clear from this example. More complex to build aggregate price indexes. We need more information and some different type of calculation. Weighted index weights the individual prices by some measure of the quantities, for example. If the weights are based on base period quantities, the index is called Las Paris price index. There is so-called per-share index. In this case, we can use in the base period, not a base period by current period. The values of Las Paris price index and per-share price index is approximately same. But in some cases, we need to use one system, not another one. So in these cases, what we need to know that Las Paris quantity, Las Paris, for example, price index of period T is the total cost of purchasing the quantity traded in the base period and price in period T, express it as a percentage of the total cost of purchasing these same quantities in the base period. And the same definition for Las Paris quantity index. But it's more convenient to consider this definition taking into account some example. So Las Paris price index for time period T. In this case, why it's a Las Paris index? It's in this case, the main reason it's this index 0 for quantity. So if we have quantity in previous period 0, then it will be Las Paris index. But if this index will be 1, for example, then it was not Las Paris but per-share price index. The difference is small, but there is between these types of indexes, and in some cases to be more reliable in constructing this index is usage average, geometric average. So a square root from production of Las-Perez price index and partial price index. But in many cases, Las-Perez price index is enough. In this case, we can see that price concern to period time of t, it's a current period, and previous price is concerned to base period, it's a 0. But so in this case, the time period of price is different in nominator and denominator. But in contrast of this, Q has a same index. In this case, it's a 0 index in nominator and denominator. So it's a way to construct this index. And taking into account this formula, we can construct the same index for quantity. So the quantity differ because now t and 0, it's indexes in nominator and denominator, but now the price index is the same in nominator and denominator. So it's a wage in both parts of this ratio to calculate more correctly. So what does it mean, this change? This does it mean don't change the quantity of sold, of product which was sold, but it demonstrates a change of costs of, for example, consumer due to change of its quantity. And in previous case, we can see that it's not a change of price, it's a change of cost of consumer when price of our product were changing. So this it's necessary to understand what if we have product of two values, then we research not the change of only one index, but we research change of product of these values. And it's important for interpretation of obtained results. Okay, so in this case, we will consider some example. So we have some items, for example, beef, pork, veal, and in this case, we can see that price of these goods is changing during time. And we can see, for example, how many quantity per capita per one person was consumed in each year. For example, 250 kilograms, for example, in 1993, and corresponding values for another items purchased. So in this case, to calculate necessary indexes, we need to use different values. For example, if we need to calculate how will change it our Las-Perez indexes in the next years, 1994, for example, taking into account, as we can see here, we can different indexes in price. So it's a price indexes. So how our expenses will change due to change of price of product. In this case, we need to multiplicate between same values of quantity and same values of quantity and different values of prices. So in nominator, so here we need to calculate, for example, calculation between corresponding values of these columns, and after that sum of all values give us $1,515. And in the next step, we need to calculate product of corresponding quantities and corresponding prices in this case. So in this case, we need 3 times 250, 2 times 150, 4 times 80, and in this case we can calculate denominator. And after that we can understand that our expenses in 1994 was on 10.55% more on the same consumer goods in contrast of previous year, 1993, due to price changing. So if we buy the same quantity of products, our expenses will increase on 10.55%. Dear Dmitro, dear Valeria, is it clear, this example?
Yes.
Okay, very good. Dmitro, what you say? Okay, thank you. And now we can go to our next example, and our next example relates to new year 1995, and in this year we also have Las Paris price index, because as you can see, we also have change in index of price, 1995 in contrast of 1993. So in this case, we can add price Las Paris index. And taking into account the same procedure, they need to calculate product between corresponding values of quantity and corresponding values of price. After multiplication of corresponding value, we can calculate sum of this value, and we will have $1,731.2. And in denominator, we will have the same value as in previous example. So after 2 years, we will have, due to change of price, our expenses will increase on 26.36%. So in this case, you can see that in each year, our expenses will grow with more rates. So in the first year, it's about 10%, but in the next year, 26 on 2 years. So it means that inflation is grow during these years. And in this case, the explanation of this calculation you can see in the end of slide. Okay. So time series data. Now we will consider numerical data ordered over time. So here you can see time series example. Why is it time series? Because it includes 2 variables. The first variable, it's a year, and the second one, it's a sales. For example, for different sales, grocery, online shop, stock exchange, etc. In the time intervals can be annually, as you can see, quarterly, daily, hourly, etc. So it can be any interval which you need to calculate some values. For example, for cryptocurrencies, it can be very short, for example, some seconds. But for example, for gold metal, it can be, for example, year, as in this example. And the sequences of the observations is important. So it's in this case, it's a historical data set from early years to next years. So a time series plot is a two-dimensional plot of time series data. So in this case, for example, we can consider some inflation rate, which will vary from what we have some very small ratio, for example, 2% till 14%. And in this case, the axis corresponds to the time periods, and the vertical axis is measure inflation rate. So it's an example of a time series where we have some phenomena, and in horizontal axis we can see some period of time. In any time series, we can consist of trend component, the main tendency or central tendency of this data set, seasonality component, for example, during summer or during window period of time, cyclical component, for example, cyclical component can be applied for working day or non-working day, and irregular component. So it's an explainable part of time series where some factors which is differ from previous one can explain change of time series. So in this case, to build a time series, we need to decompose our time series on different components, which you can see here. To understand trend, then as a rule, data taken over a long period of time. If it will be very short period of time, it's very hard to understand it's some error pattern or it's some trend pattern. So the more data you have, the more exact prediction you have. For example, if you apply LSTM model or a long short time memory model, it's a neural model, then this model very good works on very big data sets, for example, 10 years old and more. And in this case, this model can understand some interconnections between periods of times and changes of times, and after that it can give very good predict during, for example, nearest month or nearest 2 months, etc. Long run increase or decrease over time, as a rule, it's a main thing which we need to know to make decision. So, for example, our trend tendency can have upward trend, as you can see on this graph, or downward movement. So, in this case, it will be opposite side of change. So, in this case, we know, for example, if we consider very limited period of time, for example, this one. So we can understand, for example, what we have a growing trend. But if we choose, for example, another period of time, we can reveal, for example, decreasing trend. But if we consider all this period, we can understand what we can have some dynamical process, some cyclical process, and in this case, some increasing and decreasing have some consequences of changes. And in this case, we can understand to better understand some pattern in this model. So as you understand, a trend can be upward and downward. For example, if we have a downward model, for example, in finance market, in this case, we need to sell our asset, because after some time, we can buy each minimal price, for example, here. And to sell this financial instrument in maximal price. And for example, if we have upward but in this case, you can see it can be non-linear trend. We can see what in this case increasing there is during all period of time, but in some cases this increasing has some high speed, but in this case it's at low speed, and we have some plateau. So in this case, during time the sales is not changed. And for example, if it's a financial instrument and we know that it will be upward trend, then in this case we need to buy some financial instruments, because in this case we can sell it in a maximal price and to have some difference as a profit of trader on this market. So in this case, it's a simple example to demonstrate why we need to know trend for making decision. And for example, as we say before, we will have in some time series not only trend but also a seasonal component. So it's a short-term regular wave-like patterns. So in this case, for example, demand for electricity was increasing, and in spring, for example, decreasing. And for example, in summer, for example, due to hot weather, and due to winter, due to very cold weather. In spring and in fall, for example, average temperature and the electricity is not maximal usage. So in this case, if we know this pattern, we will know, for example, so in this case, for example, some prediction tell us that now we will have only winter in summer during whole years without this intermediate seasonal spring and fall or autumn. So it's another topic. But in this case, we can see that we have some repeating in this pattern. So, for example, during 1 year, we have this pattern, and during another, we have the same pattern. So we know that we have increasing trend, upward trend, but in this case, we have some violation from this trend, but and this violation have some repetition, some have same time from 1 year to another one. And for example, this seasonal component we can observe within 1 year. As a rule, it can be during month or quarterly. It's very rarely we can see one trend during 1 year and another during next year. As a rule, it's more quickly during 1 year we can see some pattern for time series data. So long term, so if we consider a cyclical component, when in this year we don't consider only 1 year, we can see, for example, 10 years and more. For example, Kuznetsov waves, when each, for example, 80 years, we have upward trend in economic development, and after that, some trend in decreasing in global development. So in this case, we can see another pattern or cyclical pattern during a very big number of years, which regularly occur, but many may vary in length. So in some cases, we can have increasing during 50 years, in another we can have consider 40 years, etc. And often measure it peak to peak or through to through. So in this case, we can consider different cyclical trends from the maximal values or from the, for example, minimum values. And then we can see, for example, that we have, for example, in current year, some sales, and from, for example, 3 years, the same maximal value, but in highest level. Yes, So in this case, we have local maximum, for example, maximal 1, and we have maximal 3. And in this case, maximal 3 is higher than maximal 1. But this period of time, for example, we understand what we have some long-term wave-like patterns, or 5 years, or 10 years, etc. And it's very important to understand which we have difference. And for example, if we have between minimal, for example, minimal 1 or minimal, for example, 2, because it's a second period. Minimal 3, because difference is 2 periods. So we can measure some cyclical values. During this, so we can have some global change. But in this case, we can see what we have periods of decreasing, period of increasing, and they can change each other. But the global trend will be, for example, such as some sinusoid, for example, curve. And we can understand what the global trend will be, this one. And we understand how what we will have some decreasing and after this increasing. And it will be another pattern, so-called long-term pattern, which we can take into account. So it's as a global recession in economy. We can have with some periodical, but the difference, for example, in 2000 years, in 2008, in 2000, for example, 11, due to COVID, etc. 2021, etc. But in this case, we approximately understand what during each 10 years, we will have both increasing in development of economics and decreasing one. And of course, we have some irregular component, as was mentioned before, in the case of unpredictable or random or residual fluctuations. Due to random variations of nature, so it's external conditions which is out of our control, and accidents or unusual events, such as war, for example, war state in Ukraine, or due to COVID, etc. So in this case, we can have some fluctuations which we can't predict in previous time, because it's like black hole. So it's unpredictable events, but they have very big impact on our current dynamics. And it's some noise in the time series. For example, it's some irregular fluctuations which have some patterns, but some people can consider some patterns in them and to try to adjust own behavior, for example, financial behavior, to these unusual events. It's very risky because very big variations can be in these periods of time. So if we combine all these components in time series, when we will have time series component analysis, and this time series use it primarily for forecasting, and observed values in time series is the sum of product of components. So it's if it's a sum of components, when we will have additive model. So in this case, it's a sum of trend, of seasonality, cyclical development, and irregular components. So sum of each of them. But in some cases, it can be multiplicative model. Xt equals product of trend, seasonality, cyclical, and irregular components. But in this case, we can to calculate logarithm of both sides. And in this case, we will have natural logarithm of x equals natural logarithm of trend plus natural logarithm of seasonality plus natural logarithm of cyclical and plus natural logarithm of irregularity. So in this case, we can transformate multiplicative model in additive one, and to apply the same calculations to them. So in this case, transformation absolute value in percentage value, because logarithm, it's a percentage. It's a percentage of growth, for example, in trend and other components. It's a type of applied indexes, but indexes in Las Paires we can calculate taking into account relations, but we can do it more quickly using logarithmic procedure to transform absolute value in percentage values. So we can consider some examples. So if we have, for example, some trend in our sales, for example, $500 per month with seasonal violation $100, cyclical violation $25, and irregular components $10, we can have some prediction, for example, of our value. So in additional time series, we can add each of these values, and we can predict that in this year, for example, we can have each month average value of $565. Positive values for seasonality indicates that existing seasons have a positive impact on sales. So we are in a growth of our, for example, in winter or in summer for our goods. The negative cyclic value suggests that the business cycle is currently is download. So is in decreasing. It means that we are now in the period of recession, for example, of economy. For example, decreasing in incomes of people will decrease demand of our goods. So it's a simple example how to apply it, these components. If we have multiplication model, so for example, values for bad debts for commercial banks. So it's a debts which bank suppose that they have no possibility to return. And in this case, if bank to calculate the main values in percent, then we have trend, it's a 10 million, for example, debts, and seasonal component, it's a 1.7%, cyclical component 0.91%, and irregular component equals 0.87%. Then the bank can calculate during this year a prediction of his bad debt, where we have trend each year plus $10 million, and during cyclical, seasonal, and irregular components, it will increase till 13.46 million. So it's only very useful and very simple way to predict some values, but in this case, we need to know average value of seasonality, of cyclical components and irregular components, taking into account, for example, developed model which you can build using Python or R, for example. So to predict some values, we need not only to know absolute value or percentage value of time series, we need to apply some types of smoothing, zglaджування. So in this case, we can apply it in both ways, moving average and exponential smoothing. It's a two main ways where we can pre-process our initial values to reveal some tendency. And in this way, we can see more obvious results of our prediction than for initial values. So in this case, you can see some different types of calculating moving average. For example, it's a point moving average. For example, then the calculate average not only for 1 day, but for example, for a week or for 2 weeks. So, and after this, we can predict our values not using individual values, but using average values. Standard moving averages and ratio to moving averages. So in this case, we transformate our initial values in some type of average and exponential smoothing. So now we can consider each of them. Calculating moving average can get for us a whole impression of the pattern for this movement during some time. And this smooth out the irregular component. So we decrease our error when we calculate average values. And in this case, moving average is averages over some numbers of consecutive time series values. So it's very simple to do it. It's a series of arithmetic means over time, and result depends upon choice of m. In short time, it can be 5 values. Average time, it can 15 values. In long term time, it can be 30 values, etc. And examples for 5-year moving average m equals 2, for a 7-year moving average m equals 3, etc. And we can calculate it, for example, when we in numerator to sum all values and to divide it on the numbers of from time where we consider these values. For example, we can calculate first 5 numbers of time series and divide it on 5. After that, after this, starting with second value, we calculate one more 5 sequential values and dividing on 5. And in this case, we can get some tendency. For example, 5 values correspond to 5 days of working week without Saturday and Sunday. And in this case, we can have some interpretable trend and some understandable change over time when if we consider only individual values, for example, separate x1, x3, etc. So average value can reveal for us more information about this time series. For example, in this year, we can consider 11 years, and each year we have some sales, for example, and we can have that we have some peaks, maximal values in, for example, second year, 6th year, 10 years. In this type, we can, after each 4 years, we have some maximal values. And in this case, if we calculate some values, when in this case, we can add first 5 values, divide it on 5, and we will have our first 5-year moving average. After that, starting from 40, we can calculate next 5 years. After that, third value, 25, etc. And in this case, we can change initial time series in sales by moving average. But as you can see, we will lose some values in initial our initial time series, because, for example, we can see that we divide on 5. So in this case, as a rule, we lose 4 values. For example, 5. In this case, we divide on 5 minus 1 equal 4. So as you can see, we lose first 4 values. So we can't first and second, as in this case. And the finish of our calculation, it's a 9 period in contrast of previous 10 and 11. Why? Because when we calculate average after dividing on 5, our time series decreasing on 4 elements. It means 5 minus 1 equals 4. If we, for example, divide on 10, then we lose 10 elements. If we divide on 2, we lose only 1 element. So in this case, as you can see, it depends on period of time which we select to average our values. And in this case, our new time series with moving average is less than previous on these 4 elements. We starting from 3rd year and ending by 9 years. But in this case, we can see tendency more clearly than using only previous initial time series. So in this case, we can see that red line, it's a moving average. And blue line, it's initial individual values. As you can see, taking into account red line, we can see very quality trend, upward trend, increasing time series in this case. But for example, for blue line, we tend to understand this tendency. Yes, we can see some maximal values, some minimal values, but we don't see trend. So in this case, moving average can reveal trend for initial data and to prepare better forecasting than individual values. So you can see another procedure. You can see it in more details in your own site because we need time to consider. So in this case, you can average only 2 time series, and you can see here example how to do it. And the third way to calculate moving average, it's a estimate the seasonal impact. So in this case, you also can consider some example where you can consider how to calculate it. And after that, to interpret the values which you have. So it's with this case, it's very interesting, for example, that in contrast of average value 1, we have some positive increasing in demand in summer and some negative change or decreasing in other seasons. So it may be interesting for you to understand this calculation and to apply it for real data. And for the second big method for revealing trend, it's an exponential smoothing. So in this case, you can also to know more about how to use it. So in this case, it's some experimental method where you need to choose some smoothing coefficient which vary from 0 to 1. And the smaller a gives more smoothing, so nearest to 0, and larger alpha, nearest to 1, gives less smoothing. So it means how will change environment in which you make decision. If it's a very turbulent environment, so in this case, alpha will be smaller. It means that historical data will have less impact on your current values. And if alpha is nearest to 1, it means that historical data as a rule repeated in future. And in this case, what was in past will be in future. And in this case, your alpha may be close to 1, for example, 0.9 or 0.95, etc. So in this case, you need to experiment some coefficient to choose necessary alpha. And in this case, as you can see, alpha means your previous data, so how you construct your new time series taking into account exponential smoothing model. So x t minus 1, it's historical data. And in this case, the more the alpha, then the more impact of historical data. The less, so the less impact. And xt, it's your current data, and it's a new tendency which is formed during current period. And in this case, you recalculate your values taking in account these formulas, and you can see example. And in this case, for example, was chosen alpha 0.2. So in this case, the current environment have a more impact on values than, for example, previous one. So in this case, you can recalculate all these values. And in this case, as you can see, exponential smoothing gives you also very clear understanding of your tendency. In this case, you can see what you don't lose any values. So you can, in only first of one is coinciding. It's the same for initial time series, but in the future period, you can see that these values demonstrate very quality prediction. But as you can see also, it's only our supposing 0.2, yes, but in this case, we can suppose such. And in this case, as you can see, we are in the bottom line. It's a support line for initial data. Maybe it's not very quality prediction, but it depends on when we can obtain, for example, for 11 years. If for 11 years it will be quality prediction, when we can leave it in such case. So you can use, for example, some software, some existing, for example, tools such as Excel, electronic tables, etc., to calculate it. And there are also very interesting methods, but from them it's a Holt Winters method or non-seasonal series. And in this case, you can consider the next slides to understand how can we prepare information to predict next values taking into account Holt Winters method. So it's an interesting method, and you can see here very good explanation how to apply it in practice. And for at least we have some autoregressive models. So in this case, autoregressive models, we applied with you in some our machine learning course as elective component in previous years in bachelor study program, academic program. And for example, autoregressive model also is used for forecasting, and your first lab works will concerning to this case. You need takes advantage of autocorrelation, first order or second order. So in this case, our future value depends of our previous values. And in this case, because our, for example, course of financial instruments depends of its previous values, and random error gives a name of this model, autoregressive. So variable impact on itself. And in this case, you can consider some model, some explanation of this model, some calculation. So you will have some example for first lab, and you can understand how can you do this work. But I need to add you some data to complete this first assignment. In this case, it's an ordinary least square method. So in this case, we minimize RSS, so residual sum of squares. So in this case, we find some parameters C1, C2, etc., Cp to minimize distance between our actual values and our predicted values. And after that, when we achieve a minimum distance between square of distance between actual value and predicted value, so it's a first terms in previous equation except of error. Then in this case, so xt minus this expression means epsilon t. So in this case, it's a summa of squared epsilon, sum of residual square sum in this case. And in this case, we using, for example, RStudio, can calculate all necessary parameters phi, and to understand how good can we predict these values. For example, when we have some office has acquired a number of office units, and he would like to develop a second order autoregressive model for forecasting the company's office units. So now you can see the company from year to year has different numbers of office as his own. And in this case, in this case, it's a very simple calculation when we, for example, take into account first values of xt minus 1 with the lag of 1 period, with the lag of 2 periods. And after that, except all these two, we can calculate, starting from 1 to 6, to calculate dependence between xt as dependent variables, and taking into account predictors xt minus 1, xt minus 2. And in this case, we can have some coefficients, phi1 and phi2, so how impact our previous number of office on our current number of office. And for example, in this case, if we substitute previous 2 years, we can, for example, predict our number of office on the next year, 2007. In this case, it will be approximately 4.6, or approximately maybe 5. So after this 6, we can predict 5 office for our companies. So in this case, we need to choose p. So how impact of our previous data, and for example, it can be 1, 2, etc. p previous values, and to test it for these values. Dear master students, so we consider our material. I sent this presentation to you in Telegram chat to understand more details in this presentation, and for example, during 1 week to prepare your material on KSU Online in English, to prepare your new labs. So which questions will you have?
No questions.
Okay, I see. Thank you, Dmitro. If you have questions, many thanks for your participation in our class today. If you need some consultation in the next week, please let me know, and we have a meeting in Zoom, and I can answer your questions. And now we will finish. Thank you for your work during this class, and see you later.
See you later.
Thank you.